Look at the skyline of any financial capital. New York, London, Singapore, Mauritius. From a distance, it looks stable. It looks regulated. It looks safe. We are told a comforting story that after the near apocalypse of 2008, when the world economy almost melted down, we fixed the machine. We chained up the big banks. We put handcuffs on JPMorgan, Goldman Sachs, and Citi. We passed thousands of pages of laws to ensure they could never gamble with our future again. We thought we destroyed the risk. We were wrong. We didn't destroy it. We just forced it to move, like water finding a crack in the dam or cockroaches scattering when you turn on the kitchen light. The money scurried into the walls. It moved into the dark corners of the financial world where regulators dare not tread. There is a new player in town. It is a ghost machine worth over $1.7 trillion. It is growing faster than the internet bubble. It is unregulated, opaque, and absolutely massive. And right now, it is the only thing keeping a huge chunk of corporate America alive. They don't have branches. They don't have ATMs. You cannot open a savings account with them, but they likely own the company you work for, the house you rent, and the debt that fuels the economy. Welcome to the money system. Today we turn on the lights in the basement of Wall Street to confront the shadow banks. To understand the shadow, you first have to understand the light. And paradoxically, this story begins with an attempt to make us safe. After the 2008 crash, Washington declared war on risk. They passed the Dodd-Frank Act. Essentially, the government told the traditional banks, you are now utilities. You are boring. You must hoard cash. You cannot take risks. And it worked. The banks became safer, but they also became useless for a massive part of the economy. Here is the problem. America runs on debt, not just the government, but businesses. The dental chain in your town, the software startup, the logistics company that delivers your Amazon packages, they all need loans to grow, to hire, to survive. But when they went to the safe banks after 2008, the banks said no. The regulations made it too expensive and too difficult to lend to anyone who wasn't already perfect. But capital is like water. If you block its path, it doesn't just evaporate. It finds a new route. It erodes a new channel around the obstacle. When the big banks stepped back, a massive vacuum was created in the heart of capitalism. There was a demand for trillions of dollars in loans, and no one allowed to supply it. Nature abhors a vacuum. And Wall Street abhors leaving money on the table. Into that vacuum stepped the alternative asset managers, private equity firms, the shadow banks. These firms looked at the situation and realized, if the banks aren't allowed to lend, why don't we do it? This was the birth of private credit, and the distinction is critical. A traditional bank takes deposits from you and me, our savings, our checking accounts. Because they are playing with our money, the government watches them like a hawk. The Federal Reserve checks their math every year. If they fail, the government insures the deposits. Shadow banks operate differently. They don't want your $100 deposit. They take billions from institutional giants, state pension funds, insurance companies, university endowments. Because they aren't technically banks, they don't have to follow banking rules. No Federal Reserve oversight, no stress tests, no capital requirement ratios, no transparency. It is what economists call regulatory arbitrage. It's doing the exact same thing a bank does, lending money to a business but calling it something else to avoid the rules. In 2010, this was a niche market, a side hustle for Wall Street. Today, it is a $1.7 trillion behemoth, roughly the size of the entire Australian economy. And they aren't just lending to distressed companies anymore. They are financing mega mergers. They are funding tech unicorns. They are even lending money back to the traditional banks themselves. The shadow banks have become the lender of first resort. They are the new kings of capital. But there is a catch. There is always a catch. When you move $1.7 trillion from the regulated light into the unregulated dark, you lose the ability to see what is rotting inside. We have traded a transparent system with known flaws for an opaque system with unknown terrors. And as interest rates have spiked, the cracks in the shadow world are starting to glow. So why would a company go to a shadow bank? Why pay 12% interest to Apollo or Blackstone when a traditional bank might charge 8%? Speed and survival. If you are a mid-sized software company or a healthcare provider and you need $500 million to buy a competitor, a traditional bank will take months to do due diligence. They will ask uncomfortable questions. They might say no. A shadow bank? They can wire you $500 million in 2 weeks? They don't ask as many questions. They just want the deal. But this speed comes with a poison pill. Almost all private credit loans have a specific structure. They are floating rate debt. In a normal world, when you get a mortgage, you lock in your rate. You pay 4% for 30 years. You are safe. Floating rate debt is the opposite. It is tied to the Federal Reserve's benchmark. If the Fed raises rates, your payments go up immediately. For a decade, this didn't matter. Interest rates were near zero. Money was free. It was the golden age of private equity. Everyone looked like a genius because leverage was cheap. But in 2022, the music stopped. The Fed hiked rates faster than at any time in history to fight inflation. Suddenly, the company that was paying $10 million a year in interest is now paying $20 million. Their revenue didn't double. Their costs did. They entered the deal with a life jacket. Now they are wearing concrete shoes, and the water is rising. This dynamic has created a terrifying phenomenon across the American economy, the rise of the zombie company. A zombie is a company that earns just enough money to pay the interest on its debt, but not enough to pay off the principal, invest in new technology, or hire new people. They are the walking dead of capitalism. According to some estimates, nearly 20% of American companies are now in this category. And remember, shadow banks lend to the riskiest companies. These aren't Apple or Microsoft, who sit on mountains of cash. These are companies that were already fragile. In a normal free market, these companies would go bankrupt. A recession would come, wipe them out, and stronger companies would take their place. It's painful, but it's how capitalism cleans itself. But shadow banks cannot afford to let these companies die. If a shadow bank lets a major borrower go bankrupt, they have to report a loss to their investors. Their track record is ruined. They can't raise a new fund. The bonuses stop. So they play a game. It has a name on Wall Street: extend and pretend. Instead of declaring the loan in default, the shadow bank lends the zombie company more money, just to pay the interest on the old money. They are using a new credit card to pay off the old credit card. It makes the loan look current on paper. No default. No bad news. Everyone gets their management fee, but in reality, they are just making the eventual explosion bigger. And this brings us to the most dangerous part of the shadow banking system: the illusion of value. In the public markets, the stock market, price is transparent. If Tesla has a bad quarter, the stock drops 10% instantly. You see the pain in real time. It is brutal, but it is honest. Private credit has no ticker. These loans are not traded. There is no daily price. So, what is a loan worth? It is worth whatever the shadow bank says it is worth. This is called mark-to-model accounting, or as cynics call it, mark-to-myth. The shadow bank hires a consultant, shows them their own data, and the consultant puts a stamp on it saying, yes, this loan is still worth 100 cents on the dollar. It is Schrodinger's debt. As long as you don't open the box, as long as you don't try to sell the loan, you can pretend the cat is alive. You can pretend the company is solvent. This is why in 2023 and 2024, while the public bond market crashed and banks were failing, shadow banks reported smooth, steady returns. Volatility laundering. They simply chose not to mark down the price of their assets. But you can only fake gravity for so long. Eventually, investors want their money back. Eventually, the zombie company runs out of cash completely. And when that happens, the black box opens. The fear on Wall Street right now isn't that one loan will fail, it's that none of the loans are worth what they say they are. We are sitting on a $1.7 trillion mountain of debt that might actually be worth $1 trillion. Or $800 billion. Who eats that loss? Hint, it's probably you. You might be thinking, why should I care if a bunch of billionaires in private equity lose money on bad loans? Let them fail. And if it were their money, I would agree with you. But here is the dirty little secret of the shadow banking world. Blackstone, Apollo, KKR, they are asset managers. Keyword, managers. They are not lending their own money. They are lending yours. The vast majority of the $1.7 trillion in the shadow banking system comes from limited partners. And who are the biggest limited partners? Public pension funds, insurance companies, university endowments, the retirement savings of firemen in California, teachers in Pennsylvania, and police officers in Florida. These pension funds are desperate. They need to earn 7% or 8% a year to pay retirees. But government bonds pay too little, and the stock market is too volatile. So the shadow banks made them a promise. Give us your money. We will lend it out to private companies. We will give you steady, high returns with low volatility. It was the perfect sales pitch. But remember Schrodinger's debt? Remember the fake valuations? If those loans go bad, if the zombie companies default, the shadow bank doesn't go bankrupt. The shadow bank still keeps the management fees they collected for 10 years. The loss goes to the investor. When the bubble bursts, the billionaire fund manager might miss a bonus, but the pension fund misses a payment. This is the ultimate wealth transfer. The risk has been shifted from the banks, who were bailed out by taxpayers, to the shadow lenders, who are funded by retirees. They are playing poker with chips that belong to the middle class, and the house takes a cut of every single hand, win or lose. But the immediate danger isn't just about defaults, it's about liquidity. Liquidity is the ability to get your money back when you want it. If you own Apple stock and you get scared, you can sell it in 1 second on your phone. Cash is in your account instantly. Private credit is different. These loans are illiquid. You are locked in for years, but recently shadow banks have started creating funds for regular individuals, retail investors. They market them as safe, steady income, but read the fine print. There is a clause called gating. It means that if too many investors try to pull their money out at the same time, the fund manager has the legal right to lock the doors, to say, no, you cannot leave. We saw a preview of this recently in the real estate sector. Investors got nervous. They asked for their cash. The fund simply said, sorry, we have reached our monthly limit. Try again next month. Imagine a bank run, but the bank just locks the front door and turns off the lights. That is the nightmare scenario for 2025. A slow-motion bank run. Investors realize the assets are overvalued. They try to sell. The gates go up. Panic spreads. The shadow banks are forced to sell assets at a discount to raise cash, which reveals the real price of the loans, which causes more panic. It is a death spiral, and because there is no Federal Reserve backstop, no FDIC insurance for these funds, there is no one coming to save them. So, where does this end? Maybe it won't be a dramatic explosion like 2008. Maybe we won't see Lehman Brothers employees walking out with boxes. The crash of the shadow banks might be silent. It will look like a decade of stagnant returns for pension funds. It will look like thousands of mid-sized American companies slowly suffocating under debt payments, laying off workers, and quietly closing their doors. We chained the banks to save the economy. But in doing so, we unleashed a ghost. We built a system where the most dangerous lending happens in the dark, funded by the people who can least afford to lose. The shadow banks promised a world without volatility, a world where line always goes up. But in finance, as in physics, energy cannot be destroyed. Risk cannot be eliminated. It can only be hidden. And when you hide risk in the dark, it grows. The lights are flickering. Check your pension. Check your portfolio. Because when the music stops this time, there won't be a bailout. There will just be a gate closing in your face.